Obviously, we hit the mid-year. We've seen a fair amount of ups and downs, new administration, tariffs coming in, tariffs being put on hold, big beautiful bills. Whole lot of stuff has been going on. Market has gone up, gone down, come back up again, and so now we're kind of hit that mid-year, and we invited the folks at J.P. Morgan, and more specifically Mayor Pandit, to come in who to speak and give us a little bit of an idea of kind of where we've been, where we are, and kind of what J.P. Morgan's perspective on where we're going for as we move forward throughout this year. Mayor's been with J.P. Morgan since 2011. She works with what I think is one of the better analysts out on the street, and Dr. David Kelly. And they put out some tremendous information. The guide to the market is, quite frankly, in my opinion, the Bible that I think most financial firms look at to really kind of get a perspective on what's going on, not only in the stock market, the international markets, the bond market, so on and so forth. And Mira's been a big part of that. She is a graduate from Tufts University, holds her Series 763 CFA, which is, quite frankly, the most difficult exam to pass in the financial services arena. So Mira, thank you so much for taking time out of your busy day. Welcome to ICG Next. And so what's looking good for 2026 or
Thank you.
2025 going into 2026?
Thank you so much for having me. Yes, we are just beyond the mid-year point. So it's a good time to take stock of what's happened so far this year and where we could be going in the second half of the year. And since it has been such an eventful year, it is worth remarking that despite all the different headlines around tariffs, war, AI, DeepSeek, existential risks there, the debt ceiling, taxes, you name it, the market is up about 8% year to date. And you have seen many different options in a portfolio for growth and protection. So, with that in mind, it's a good reminder that during times like this, where there is a lot of volatility, there is a lot of uncertainty, it's really important to have a plan and to stick to that plan, because the investors who trade around and get too sensitive around some of these headlines are the ones that tend to lose out on in the long term. And as we head into the second half of the year, we do see a reasonably good environment overall as it relates to economic growth, slowing, but still growing. We could see a bit of a pickup in inflation, but certainly not a surge. We have seen, from a profits perspective, some pretty good earnings out of companies, and all that should support markets. We've seen success in the US markets. We've seen success in international markets. We've also seen some pretty good returns out of fixed income. And we do expect the road ahead not to be without its potholes, but overall to trend in a reasonable direction. So if we take a look at the first slide on the next page, looking at the overall economy. Typically, the economy on the left-hand side grows at about a 2% pace in blue. But if you look at the line in gray, more recently, we've been above that pace for the last 4 years. So overall economic growth has surprised to the upside. This year, irrespective of any of the policy changes we have seen, we expected to see some slower growth overall. Now, if you add in some of those policy changes, like higher tariffs, if that increases prices, it could decrease the amount that overall consumers want to buy and drag on growth. But that starting point matters so much, because it means that we could potentially see slower growth, but probably avoid a recession this year and into the first half of next year. And you've seen on the right-hand side all of the three major actors in the economy: businesses in gray, government in green, and of course the consumer, the real backbone of the economy, in blue, continue to spend. Perhaps again at a slower rate, but nonetheless firing on all cylinders. Now, consumers were very buoyant in recent years, which helped growth. There was a lot of excess savings. They were buying goods, they were buying services. They don't have as many tailwinds at their backs anymore to spend. But fundamentally, if we look at the next slide, the worker is the consumer is the worker. So if the jobs market looks okay, then people may not be able to splurge, but they can meet their basic needs. So if we look at this chart here, it looks at the unemployment rate over time in gray, which is just around 4%. Now, if you look over the course of the chart, generationally, this is a pretty low unemployment rate, and it's stably low for the last couple of years. So psychologically, people feel pretty good about their job prospects. In addition to that, if you look at the blue line, it looks at wage growth on a year over year basis, which accelerated into the pandemic. It has decelerated, but plateaued at a pretty high level, commensurate with prior peaks in wage growth. And even outside of inflation, wages are positive when we think about that growth rate over the last 2 years, further supporting consumption. So maybe not a splurge, but certainly we still see spending because of this stronger labor market. Now, it's not without its headwinds. If we take a look at the next slide, the last couple of years have been marked by higher inflation, but we have made tremendous progress, which you can see on this slide here, where we look at the year over year change in inflation and all of the different factors that add up to it. So we made it from 9% inflation to just over 2.5% inflation, but there are still some changes afoot. And again, I'll bring tariffs into the conversation because they're likely to make goods prices higher. In fact, we're already starting to see that. If you take a look at that orange category, you look all the way to the right, you can see just a very tiny sliver that's higher from an orange standpoint. Those are goods prices. Now, does that mean we're going to see something like we saw in 2022? Not in our view, because in 2022, you had in green and in purple a big shock to commodity prices. We have already seen a war this year that didn't cause that same shock. You had supply chain issues, which affected the category in orange. You had massive consumer spending. Again, consumers don't quite have that firepower anymore. That showed up in the areas in orange and in blue. Light blue is services. You also had in darker blue, housing really heat up. And in fact, housing is cooling off. So what we anticipate is a lift in inflation to something slightly above 3%, but then a shift as people spend more on, or their goods cost more, and then they maybe want to pare back on other items, perhaps in the light blue category, things like movie tickets, concert tickets, dining, international travel. So overall, that can help inflation slow in the next year. Now, with the tax bill and with a potential boost to growth in 2026, that may keep inflation slightly hotter for a period of time, but then it is likely to cool off thereafter as growth slows down. Inflation and growth tend to move together. That's what makes us feel a little bit more confident that we're not going to see a pronounced spike or the magnitude of a spike that we saw back in 2022. Now, when you put this together on the next slide, our central bank, the Federal Reserve, has a dual mandate. Essentially, they are looking at price stability, so think inflation, and they're looking at maximum employment. So think about that labor market picture. Now, they might be pointing in slightly different directions right now. If you look at the federal funds rate in gray on this slide here, we're currently just above 4%. And the Fed does believe that we are somewhat restrictive and could cut rates, especially because some of the job data is looking a bit weaker. Not weak, but a bit softer than it was. However, if inflation does start to pick up, that would advocate for the Fed not cutting rates and instead keeping them right where they are. If you look at the blue and green lines, those look at where where rates could be going over the next couple of years. And the Fed penciled in 2 rate cuts of about a quarter point each this year. And the market is broadly in line, expecting that as well. So we may see the first rate cut in September. We could see another one to end the year. But remember, if inflation is starting to move a little bit higher, if growth into 2026 gets a little bit hotter, we're probably not going to see a massive amount of cutting from the Federal Reserve. So we are probably going to still be, even if we do see cuts, in an overall higher for longer environment. Now, the good news is over the last couple of years where we've had pretty high interest rates, profits have been robust. Equity markets have done well and, in fact, supported much higher valuations. We've continued to see businesses spend, borrow. So the level of rates right now hasn't necessarily damaged the economy. We can be resilient from an economic and market perspective, even if the Fed keeps rates higher than we've seen over the last 15 or so years. Now, when I think about other implications around higher for longer, I think about the bond market. So if we take a look at the next slide, this slide looks at, on the left, various areas of the fixed income market, and on the right, some different interest rate scenarios. So on the left, we look at it in the top, different maturities of treasuries. And then in the bottom, we look at different sectors within the bond market. Now, a lot of numbers on this page. We really try to design our charts that only the colors matter. And if you look at that third column in where we look at the returns, you can see they're mostly in the black, mostly positive returns across the board, except for a couple of different areas. So diversified fixed income has worked. Whether you're at the shorter term maturity, a more intermediate term, whether you're in corporate credit, high yield, a number of different areas have worked this year. And that might seem a little bit surprising because we've had several episodes where bond yields have moved higher. When those yields move higher, bond prices move lower. And again, in fact, we've seen a pretty good outcome across the bond market. So diversified fixed income has worked. Now, going forward, although there are risks to yields moving higher, there are risks to yields moving lower, they're not necessarily symmetric when we think about the outcome for us investors. So what the right hand shows is we look at the same maturities, the same sectors that we do on the left, but instead we look at a couple of different scenarios if they played out over the course of 1 year. We look at if you had 1% fall in rates in navy, and again, rates fall, bond prices rise. We also look at a 1% rise in rates in gray, and the opposite effect is there. And then we look at no change. Now, if you were to see a 1% rise in rates, let's take a look at the general bond category, US aggregate, about halfway down the page. You would be looking at, on a total return basis, about a return of 1.4% lower. Not great, but also when we think about the carnage that we experienced in 2022 when rates were going up pretty rapidly, certainly not on par with that. On the other hand, if you were to see a 1% fall in rates, you'd be looking at something like a 10.7% return because rates are at a higher starting point. So you have a pretty healthy income component, and then you also have the impact of rates falling, bond prices rising. Now, I wouldn't expect to see a 1% fall in rates. Equally, I would not expect to see a 1% rise in rates. We'll probably see rates stay somewhere between 4 and 4.5% on the 10-year treasury yield. We're at the upper range in that regard. So even if we see rates do basically nothing this year, no change in lighter blue, you're still going to clip that coupon and get about a 4.7% return in aggregate bonds. That's why the bond market has become attractive again. Bonds are relatively cheap, and they're also providing ample income to help not only throw off yield in a portfolio, but also to cushion some of the rate moves. Now, when I think about the equity market on the next slide, this has also been a year where broad equities have worked. In fact, this year, for the first year in a long time, we have choices across the equity market. So the left-hand side shows the Magnificent Seven mega cap tech stocks in green, along with the S&P 500 as a whole in gray, and S&P 500, basically everything else outside of those tech stocks. And if you look at that final line in the table, that share of returns, you can see there that the Mag 7 drove the stock market in 2023 and 2024 much higher. And the line shows that, how successful those stocks have been. But this year, it's been a bit of a different story. Back in April, the rest of the market was about flat, whereas the Mag 7 were down about 25%. Now, the Mag 7 have come back a long way, but the rest of the market is still doing reasonably well. If you look underneath the surface, the best performing sector this year is industrials. You're also seeing areas like utilities, financials, materials do well. And tech is doing well also. But if you look at the best 50 performing stocks so far year to date, only one of them is a Mag 7, and it's towards the bottom of that 50. Now, 17 other stocks are tech companies. What that reminds us of is there's not only the Mag 7 when it comes to tech. And what it also reminds us of is both value and growth are showing up for portfolios this year. So finally, again, we have a diversified source of choices. Doesn't mean you want to dump the Mag 7. If you look at the top right, you can see that earnings growth of the Mag 7 in green relative to the rest of the index is still looking pretty strong, but the rest of the index is starting to catch up a little bit. It also means we can't just treat the Mag 7 as a monolith. If you look at the bottom chart there, all the way to the right, the best Mag 7 performer this year is up 28%, but the worst is down 18%. So it is certainly not a time to take your foot off the pedal when it comes to active management around some of these stocks, and of course, beyond just these stocks, different areas of the market. Now, on the next slide, when we think about choices, it's not just value versus growth in the US. International has also become a really viable opportunity for the first time in about a decade. So what this slide here shows is sources of global equity returns, a ranking of different regions across the world. We look at the last 15 years, 2024, and 2025. And of course, when you look at the rankings here, which one is not like the other? This year is looking pretty different than the last several. Now, some people say, well, international's done so well because if you're a US investor and you're owning these stocks in dollars, then you're making a big excuse me, benefit from the fact that the dollar has moved lower. Now, you can see that component in purple. But if you look across the board here, excuse me, it's not just the currency component here. It's not just about the dollar, but each individual region has different catalysts. So take a look at Europe, for example. Yes, the dollar and the currency component has been important, but you can also see locally on the ground, I'm so sorry, woo, that some of the big drivers there are fiscal stimulus. The government, after years of not wanting to spend money, has been spending a whole lot more. You can also see that interest rates are back at 2%. In the US, they're almost 4.5%. In China, it's all about AI and technology. In the emerging markets outside of China, areas like Latin America are doing well when we think about beneficiaries of other trade partners. Asia is doing well. Technology, corporate reform, you see that in Japan as well. So importantly, internationally, there's a number of different catalysts and they don't depend on each other. So even if one of these stories doesn't work out, it doesn't mean the whole international story folds. So we have options when it comes to international, when it comes to the US market as well. Now, next slide. The big challenge here for investors is you feel really good about what your portfolio has done, but markets are back at all-time highs. So the question is this a good time to put money to work? Because the basic principle of investing is buy low, sell high. And we're now at an all-time high. But importantly, there's some nuance to this. We can see on the left is all-time highs over time, and you can see that they cluster together. In fact, 81% of the time, all-time highs occur within 1 week of each other. And 30% of the time, that all-time high acts as a new market floor. So we will not go back below that level again, 30% of the time. Now, when I think about the momentum around all-time highs, it compounds over time. And that creates the dynamic on the right. It's very counterintuitive, but actually investing in a new all-time high, because of that momentum, can actually give you better returns over the long run on average. So investors need not fear investing at all-time highs. We still want to be active, we still want to be careful, but it's not a reason to stay on the sidelines. Now, if we look at the next slide, sure, we may still see some pockets of volatility ahead, but remember that volatility is a feature, not a flaw within the markets. What this slide shows is the S&P 500's calendar year return, and then the maximum the market fell in red. This year we were down 19% at one point. Didn't seem like we could come back from that. And yet year to date, we're up about 8%. But this is not necessarily unusual compared to the past. In fact, if we look at the average decline in the markets, it's about 14% over time each year. And yet 75% of the time, that eventual calendar year return is positive. So the patient investor has been rewarded. But as I mentioned up front, it's not just about patience, it's also about having a strategy to deal with these periods of volatility. A strategy that you can depend on no matter what the headline is or what is going on. And if you take a look at the next slide, that strategy has worked this year. This slide looks at a ranking of top to bottom asset classes by year. And then we also show a diversified portfolio in the white boxes cutting down the middle of the slide. What you can see here is it's really hard to guess what's going to be the best performer one year. And sometimes that best performer is the worst performer the next year. And if you look at 2024 and 2025 all the way to the right, they're almost mirror images of each other in terms of what worked last year relative to what worked this year. This year's been all about the unloved areas of the market: international, value, bonds. It's a good reminder that diversification works when you least expect it and in the way you least expect it. So that diversified portfolio this year is up 7.7%, probably a little bit more because these slides are as of a couple days ago. So again, that portfolio, that strategy, that long-term plan has helped to protect. It's also helping to grow portfolios so that you can meet your longer-term investment goals.
So on behalf of the entire team at ICG Next, enjoy the beautiful sunny days, the rest of the summer.